Hello. Radiant Cash Management Services is not having the best of times. The share price of the company has really gone down from 73 rupees now around the mid of May 2025 to then 56 rupees around October 2025 and now January 19, 2026, 48.78 rupees per share price. And more importantly, the earnings of the company have not been doing well. So these are the quarterly results of the company, okay, quarter by quarter. Now pay attention to the sales and below that, the year on year sales growth. Okay, the year on year. You will see September 2024, 14% growth. December 2024, 15.16% growth. Then March 2025, suddenly only 5.5% sales growth. June quarter, 0.18% sales growth, barely any sales growth. In September 2025, latest quarter, minus 2% sales growth. Okay, minus 2%, not the biggest of deals. But take a look at this. The operating profit margin of the company has really gone down. Take a look at this. December 2024, 18.7% operating profit margin declines to 12.8%, then declines to 9.6% operating profit margin. Latest was 11%. For comparison, September 2024 quarter operating profit margin was 17.84%. September 2025 quarter operating profit margin was 11.26%. And you can see the difference. Take a look at this. Net profit. All these numbers are in crores. So in September 2024, net profit for the quarter was 13.02 CR, declined to 7.66 CR at September 2025 quarter. It's a massive decline. So, are things that bad? Now, reading the latest con call though, okay, the latest conference call, the outlook of the business actually seems positive. So, let us now read the con call. Here we have questions and answers. The Q's are for questions asked by shareholders of the company. A are the answers given by management of the company. So, let us start. First, question by analyst or shareholder. I have two to three questions. First of all, quarter four con call. You guys say this year our target would be revenue growth 15 to 18%. H1, that is first two quarters, we achieved only 204 crores. So, how can we achieve, sir, 15 to 18%? It's difficult. That's the first question. Okay, the question is the last conference call, the earnings conference call, management has said that in fiscal year 2026, they will do 15 to 18% revenue growth. But in quarter one and quarter two combined, that is the first half or H1, they did no sales growth. So will they still achieve that overall fiscal year 2026 target 15 to 18%? Now the answer by management is yes. At a consolidated level, last year a full year consolidated revenue was 433 crores, and yes, it may not meet that exact target, but it will be closer to that. It's not going to be sharply different. So they believe that 15 to 18% growth will not be achieved, but the revenue that will be achieved by combining the quarter 3 and quarter 4 revenues with quarter 1 and quarter 2 will not be that much far from the target. So they're expecting some good growth in quarter 3 and quarter 4 so that this 15 to 18% target, it's not met, but the results are close to it. Results are close to it. The question continues, will the revenue be better than last year or similar to last year? Answer, definitely better than last year, definitely better than last year. Okay, management's words that revenue for fiscal year 2026, despite the first two quarters being flat and negative, as we saw earlier, management is still guiding for fiscal year 2026 revenue to be higher than fiscal year 2025. So quarter 3 and quarter 4 better deliver. Now, very important question. Okay, what would be our EBITDA margins, sir, going forward? The operating profit margins or the EBITDA margins? Big decline. What's the answer? See, we have not given specific EBITDA guidance for the remainder of the quarters. First quarter to second quarter, there is an improvement. Now, very important thing. Look at this. First quarter, June 2025 of fiscal year 2026, 9.66% operating profit margin. Second quarter, September, 11.26. So substantial improvement from quarter 1 to quarter 2. That is what they're talking about. He's talking about this improvement. Let us continue. And we are definitely confident that second half EBITDA margins will be much better than quarter two margins, much better. So they're expecting quarter three, quarter four EBITDA margins to be much better than the 11.6% EBITDA margins, and revenues made in quarter three and quarter four are such, will have such growth that they will surpass, that the overall fiscal year 25's revenues will be surpassed. All right. Now, let us continue. One more question. This is a big one. Okay. Got it, sir. That was really helpful. And the next question I had, I just want to understand the targeted EBITDA margins that we are looking for. Because in the current quarter, from where I can see, is that we have improved from 11.6% to 13.1% sequentially. How do we see going forward in quarter three and quarter four? Because catching up with the festive season, I think there should be some positiveness circulating in the market. I just wanted to have a viewpoint and understanding on that. So, overall profit margins over a longer period of time. On this, the answer is actually pretty nice. It's very nice, actually. The answer by management is we have not put out specific number guidance for the remainder of the year as yet, but definitely the trend line what you saw between first quarter and second quarter, it will definitely sharply improve. What we had said in our earlier analyst calls is that, in a sense, fiscal year 2027, as in the next financial year, our hope will be to reach past historical high levels, which is our 25% EBITDA margins. Okay, hold up. So, these are the profit and loss of the company. Okay, fiscal year 2023, where they produced 355 crores of sales, all these numbers are in sales, they were able to achieve 87 crores of operating profit, 25% operating profit margin. So these, and see, for fiscal year 25, 22% operating profit margins, and the latest two quarters, let's go back to these horrible quarters, 9.66%. Before that, 12.84% operating profit margins, 11.26%. Drastic decline. So now they are saying that they're hoping, they're seeing the demand, all of that. They're hoping that in fiscal year 27, maybe by the fourth quarter of fiscal year 27, there will be improvement from quarter one fiscal year 27 to quarter four fiscal year 27, maybe. But by some point in fiscal year 27, they want to reach past 25% EBITDA margins, at least reach 25% EBITDA margins. That is awesome. That's great. If they can do that, that will be amazing. So yeah, let us see if they can reach 25% EBITDA margins. But at least what we do get is that management is guiding quarter three, quarter four to be better in terms of growth and of course profit margins. Now, question is this answer. My fault, I forgot to write A. So question was, sir, for the rest of fiscal year 26 and 27, sir, can we expect to grow at the mid-teens kind of revenue growth where we can achieve a margin improvement? Mid-teens, 14-15% revenue growth. Can we do that? Answer is C. Definitely, there will be a margin improvement, both revenue growth as well as margin improvement. October festive season has been fantastic for, as you would have seen in many other companies as well. So, same is the case for us. October has been good. We're expecting that the trend will continue. We will report definitely much better margins than the first half of the year. Again, same point, quarter three, quarter four, way better margins, and of course, revenue growth he mentioned. The management mentioned, not he or she, the management mentioned. Yeah, revenue growth to be there. Now, this is a longer paragraph. All of this is said by the management about the business, the key measures they're taking. So let us start reading from the hold up. Let's start. Okay. So left to right, of course. I'm highlighting the key measures below, which I believe would start yielding results in the coming quarters. We have started offering a wide array of services to banks to capture a higher wallet share. So, the existing customers, whatever percentage of the spending that the existing customers are doing, which Radiant is getting, okay, out of the total spending for, let's say, ATMs and all of that, what percentage Radiant is given is getting right now. They want to offer even more services to existing customers so they can increase their wallet share. Let's continue reading. These services include cash sorting machines, ATM replenishment through cathode swap, cash deposit machines, and an increased thrust on cash van operations. We have strengthened our clients' direct clients business which has continued to grow at a healthier pace and now constitutes 15.7% of our standalone revenues. Wait, they have strengthened their direct clients business, not even businesses, business. Direct clients business is now growing at a healthy pace and constitutes 15.7% of their standalone revenues. Okay, so first thing, they're offering more and more services to capture more and more spending of their existing customers. Okay, second, we have initiated certain cost reduction measures across every region through rigorous benchmarking of several productivity measures, which is expected to reduce costs to the tune of 50 million rupees, or I think 5 crores, on an annualized basis at current level of operations from the third quarter onwards. So, they have taken cost reduction, cost control, and productivity increasing measures. These measures are expected to reduce costs to around 5 crores annually, reducing costs by around 5 crores annually, and they're looking to begin from third quarter onwards. So, one, more services offered, capturing more wallet share of the customer. Second, cost control measures. Now, third measure, a strong focus on achieving growth and break even in the valuable logistics segment has resulted in near doubling the revenues in this division, though on a small base. While costs have increased correspondingly in this quarter on account of a few senior hires and new routes for our marquee customers, we are confident of significant improvement in gross margins and achieving break even in the current financial year. So, this segment of Radiant Cash, which is valuable logistics, this is one of the businesses which is currently loss making, and I think it's newer. If I'm wrong, please correct me. But I think this is a newer business, so valuable logistics. So valuable stuff being transported, I guess. This is currently what? This is currently in losses. This is a loss-making segment. So they're hopeful that they can achieve significant improvement in the gross margins for this segment and achieve break even. So cost reduction, all right, then achieving break even, then of course wallet share. They've already been able to double the revenues for this quarter. Though it's still small. That's why, doubling is easier, but still they were able to double. And of course, while double revenue, costs may have also increased correspondingly. So they may also have doubled, but there were some, let's say, newer stuff, some exceptional things like hiring new senior hires. They will not be hiring senior hires every quarter, of course. Hopefully not. New routes for our marquee customers. So when things stabilize, they have the same senior hires and the routes are the same. They're not introducing maybe at the same pace. They will control costs, increase revenues, and yes, achieve break even in this segment. So yeah, three measures we did. All right. Then finally is about their fintech subsidiary. Okay. Presenting the update on Radiant Ace Money, our fintech subsidiary. Okay, Ace Money. After a sharp drop in revenues and significant losses in quarter one due to a vendor transition issue. Significant losses. Does this explain this? Like quarterly results? Ooh, look at this. Significant losses in quarter one. Okay, no. That happened in quarter four already. March 2025 was quarter four. But okay, this could have contributed. This could have contributed. So significant loss in quarter one due to vendor transition issues. So they were transitioning from like to different vendors, to different suppliers, which we highlighted earlier. Radiant Ace Money has now bounced back and reached revenues of 49 million rupees or 4.9 crores for this quarter, up from 1.7 million, 1.7 crore rupees in the previous quarter. So this is the valuable logistics one, which they were highlighting that the losses one. I think this is the one. Though, due to extended impact of the disruption in the first few weeks of this quarter, the performance is still below the delivery capacity and market potential for this business, resulting in EBITDA level losses of 1.56 crores. Wait, 1.56 crores of EBITDA level losses. So from this fintech subsidiary alone, where the revenues are like 104 crores, 1.5 crores of EBITDA losses. EBITDA was 11.79 crores. So 1.5 crores. Okay, fine. Okay, so there were disruptions. There's a temporary disruption because of vendor transition. The business has now come back to healthy profitable levels, and we are confident that Radiant Ace Money will fully wipe out the losses incurred in the first 6 months and contribute meaningfully to the overall profits of the consolidated entity in the remainder of the year. All right. So I guess the valuable logistics segment, I think this is Ace Money, or they have like two loss-making segments, which is okay. But okay, so Radiant Ace Money, it had a temporary issue led to EBITDA level loss of 1.56 crores. The issue was vendor transition, so they're transitioning to a different vendor, which has caused a lot of disruption. Now, with that impact slowly going away, business coming back, you're confident that all the losses in the first 6 months, so total losses made, they will wipe it out with profits. So they will wipe out the losses, let's say minus XCR, they will have plus XCR of profits, wipe that loss out, and now generate more profits that will contribute to the overall profits of the company in the remainder of the year. So that was it. That was Radiant Cash Management. It seems that the company is optimistic. Optimistic. As a summary, quarter three, quarter four, better margins than quarter two, substantially better margins, better growth, and their aspirations to achieve 25% EBITDA margins by the end of like fiscal year 2027. We are currently at around the end. We are in quarter four of fiscal year 2026. So, yeah, and of course, the loss making subsidiary, they are working to make it now profitable and they're very positive in making it profitable. And of course, certain cost reduction programs and bringing out new services. That was it. Let us see how Radiant Cash Services, 524 crores market cap right now, 13.4 times price to earnings ratio, does in the future. That is it. Bye.